I got called Bono on the last the last session. So my name's Sam Newton. I set up Gravitate 6 years ago, and like I say, this is exactly where we wanted to get to. There was no real plan, but being able to work closely and support clients through their full business journey, essentially. And as I mentioned earlier, this is Martin, who heads up our corporate finance team, and I'll let you introduce yourself.
So I joined Gravitate probably 18 months ago now. Prior to that, I used to work at another local firm purely doing M&A. So I'm a qualified accountant by background, but I've been doing merger and acquisitions for 10 plus years. So what does that mean? I act for buy side and sell side companies. So, the good thing about that is that, because I act for both sides, I know what a buyer wants to see. So when it comes to selling your business, I'm probably in a good place to tell you what you need to do to maximise value, to make the process as streamlined as possible, and help from that point of view. So businesses I tend to typically work with, any SME businesses, so I don't get involved in flotation of companies, etc. It's predominantly in a space where owner-managed businesses with profitability anywhere ranging from 100 grand up to 3 million. So that sort of space. So that's where this sort of advice is steered towards for those type of business owners.
Perfect. And so I sort of alluded to it a little bit earlier. So my role last year, I actually took on a role as a finance director for an outsourced finance director for a health group, essentially. So worked with those guys from when I set up Gravitate, so best part of 6 years, with the whole plan really of building that business to sell. And so that whilst I was with them, they grew from about 1.5 million turnover to about 22 million in that time. So it was really rapid growth. But the whole plan was to, they knew they wanted to sell the business at some point, and that's why they sort of got us in and had our services. So it was, we sold, the company ended up selling significant value. It was basically us versus KPMG. KPMG acted on behalf of the private equity firm who bought them. And I think, like you say, we haven't been in there for that period of time. We got to know the business. B, we prepared robust financials. And C, we sort of got to know the story and the journey that they've been on. And so it was, like I say, it was probably one of the most stressful periods of my career, just because, like I say, it did feel like it was me versus KPMG at some point. But like I say, what we did really well was they sort of set themselves up as, so when I started a £1.5 million turnover business, they were having board meetings, and I was like, it felt a bit overkill when I first started, but I think I agreed to learn why they were doing that process. Like I say, having these board meetings, because things like they want to look, as part of the process of selling the business, they wanted to look at the board packs that were prepared for the last 3 years, the board meeting notes, the risk register, and like you say, a risk register. Again, it's sort of some people think, what's the value in doing a risk register? But for someone buying the business, like I say, they saw, like I say, 36 months worth of risk register and how we dealt with each situation, and it's actually quite valuable for them, because obviously every business goes through, it's never plain sailing, there's always bits going on in the background, but to be able to demonstrate this is a risk or the issue that we flagged, and this is how we dealt with it and minimise that risk, is quite useful. So things like, let's say, having these board meetings and having the financials are fairly important, and so what KPMG essentially will have done, they will have took that 3 years worth of data and put it through some kind of system to say, okay, these are the anomalies. So they would just pick out the spreadsheet that they end up pulling together, which was essentially a query spreadsheet, probably went into the thousands from when it finished, because it starts off with 50 questions, like general overview questions of, okay, what's the plan with the business? And then it evolves and evolves. So every question they ask, every answer you give probably leads to 4 or 5 more questions. So like I say, we were there just responding to all these queries, and I expect a lot of it will have been generated from putting those numbers into into one of their systems, and it's saying, okay, these are anomalies, find out what the anomalies were, and so it will be like, okay, why did the margin dip in that month, why did the margin shoot up in that month, and like you say, by having these management accounts that we could go back to. Obviously, like I say, it was 3 years of data. I was technically working for them one day a week at one point. It went up to 3 during the transaction. But yeah, I think having the board packs to relate back to, because like I say, I wasn't even full time, so I didn't know every nook and cranny of the numbers. A lot of it was what was happening that month, reported on it, and then we'd move on quite quickly, kind of thing. But having those board packs to relate back to, and like I say, this is what happened, this is the scenario, and like I say, a lot of businesses that aren't simple businesses, if you're not doing the monthly management accounts, then there's always going to be adjustments. So like I say, even if you're really good at doing your bookkeeping, so you're reconciling your bank every day, you've got your sales and you've got your purchases in, but for any business who for example, will sell contracts, so if you're selling a 12-month contract and you're not deferring that revenue over those 12 months, you can see, looking back to the scenario I had, how it would cause massive fluctuations in profit. And so I assume from an M&A perspective, they're always looking at margin and growth.
It's understanding, they're always looking at the P&L and cash flow. So cash is king, that's the analogy, the popular one, and it is 9 times out of 10. But also profit and loss is key as well, the relationship between the two, and explaining it, because you might have a very profitable company, but the cash is poor. Well, that suggests that the working capital management's poor, so you're not getting stock in quick enough, you've got debtors there that are maybe too generous on the terms. So they're looking at both sides. But I think what a lot of the time with businesses that don't really focus on the financials, their profit and loss looks like a cash flow, and again, from a buyer confidence point of view, they need to come in and understand why is that the case. So it's harder to do that if you're not on top of it. And you touched on like the sort of 3-year time. That's a good period that you need to be looking at your financials, and you've got that consistency. Because again, if I was on the buy side, I'd want at least 3 years worth of financial data, and I'd want to know why trends are X, Y, and Z. And I want to see that link between profit and loss and cash flow, and understand the differences. So yeah, it's just really important to get those financials together, and the reason why really is that if you have the robust information today, and we're focused on financials, but there's legal aspects, there's commercial aspects as well, but just focus on the financials. Why is it important? Well, it's going to increase your valuation because the buyers can rely on the information. And also the deal structure as well. You're going to get favourable terms because it's less risky for them. If we can explain to them why things have moved up and down and the reasons why, they're going to get more comfort, and they're going to be a bit more relaxed in terms of maybe paying you more on day one, and the rest maybe less concerned about having an earn out, deferred consideration. So the more you do now and front load it and get prepared, the better valuation, the better terms you're going to get when you exit as well. And often most SME business owners, they only do it once. So I always compare the analogy of selling your house. Really, if you're selling your house, what do? Well, you frantically go around and tidy it up. If you've got someone coming around, you do it and you prepare for it. But we don't want that frantic process. We want it to be fully prepared well in advance. So when people come round, they see the business and it's tick 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 in every box. So
perfect. So. And like I say, another thing that like I say from my experience was the KPI side as well. So they weren't just looking at trends in pure financials. So like I say, the numbers were important, and like I say, anyone who's got income that it doesn't fall in that month, whether it's deferred income, accrued income, costs that don't fall in that month, so stock, again, accrued cost, prepaid cost, that's the key from the financials. So you've got that real consistency across those 3 years. You then go into KPIs, and again, they wanted to know, so in this business it was, well, there was a group of 5 companies, but it was sort of driven by referrals. A lot of referrals from medical companies essentially would drive the revenue. So they would, again, they'd then bring in the KPI data and say, okay, how does that track compared to revenue? So again, we were fortunate that we were tracking the KPIs for that full period, and it wasn't something we had to then go back and rebuild. So we had all that data tracked within the management accounts, just to say, okay, here it's a job of exporting that information and send it over, because the last thing you want to be doing when you're in a position where you've found a buyer and you are happy with their offer is delaying the process. And so everything became about time, and so if we go on the next slide, we talk about transaction readiness. These are all things you can be doing in that build up to a sale, and like I say, if you can get good practice in from the start, then that's key. And like I say, tracking the key performance indicators that are relevant to your industry can be really important.
Yeah. I think, like, you know, some key ones like people won't necessarily think about when they get management accounts, things like, you know, pipeline jobs, leads, website visits, number of employees, so you can track average number of, return on investment from employees, with, linked to sales. There's lots of different non-financial KPIs that then you can start to measure against your financial performance. And these are the sorts of things that a buyer would see. But I think getting involved early in the process, talking to your advisors and having that conversation about what is a key performance indicator for our industry, and then you can start to monitor and track it before you get to the point, because you're not going to be able to do that going backwards. It's going to be a lot harder if you don't do it at the beginning.
And then, like I say, we briefly touched on it before there, but transaction readiness, it's a combination of the two things we touched on before. Like I say, the whole point is you want to make this business ready to sell, and why not start that process now? Like I say, I think some of it comes down to the story that I mentioned earlier, and like I say, building that up. But a huge part of it is being transaction ready and knowing what might come up. Like say, no one's expecting it to be squeaky clean for 3 years, but being able to explain what has occurred on that journey is so important.
I think that's the key, is being able to explain movements. So if you've got an answer ready, then it just inspires confidence. Okay, that's fine, we know that now. But if your answer is, I don't know why the margin went like that for that period, again, what starts to happen is the buyer starts to lose confidence. And again, going back to what it means really is that it goes back to valuation. They're more likely to reduce the value, and or the deal structure is going to be less favourable as well. So you might, by tracking these things as we go along, yes, it's time and investment doing it, but the idea is it's the end return that you're focusing on. You're focusing on the end goal and maximising that end return. So again, in terms of transaction readiness, why is it important? It goes back to that maximising valuation. If you can identify sort of red flags early on in the process, and that might be things like, I don't know, you might have focusing away from financial elements. So you might have contracts with your customers. Well, how robust are those contracts? Are they defensible? So again, getting legal advisors involved to do a bit of legal due diligence specifically on those contracts. Same with employee contracts. Are your employment contracts strong enough? Are there protections in there for you as a company? Because that's the focus. The buyers are looking at the company here. They're not looking at individuals or shareholders. They're looking at, what protections are there in the company? So there's tons of things that, as part of transaction readiness, it's going through your business and highlighting what areas that might be weak, and areas to focus on from it, but really focusing on that exit in 3-5 years time, whenever it might be, because by doing it early, you've got a chance to mitigate those risks, which is really important. Sam's touched on it as well. Another reason why transaction readiness is important is that it reduces what's known as execution risk. So when you get to a process, if you've got packs ready, data room ready, everything ready for a buyer to see, because often deals fall over or become less favourable the longer it goes on. So we found a buyer, you're ready to sell your business. If everything's there ready, and we'll touch on it in a minute about data rooms and packs that we might want to prepare before sale, but if everything's there ready, well, there's no reason that transaction can't get done quickly, because the longer something takes to transact, the more likely they're going to find issues and find problems and chip the price, and basically you end up with a less sort of favourable deal structure as well. So again, that's another reason why transaction sort of readiness is important. That's it.
No, perfect. And yeah, I think obviously you mentioned a data room, so would one of the slides go into it a bit?
I think a little bit more, yeah.
So 'cause a data room is, if you can imagine, you essentially are building out a file structure where you can just transfer all this information over to the buying party. So you will almost have like a SharePoint, and you'll have probably, I mentioned earlier about those over 1,000 questions that we've got on the transaction. That isn't just on financials, and I know Martin's alluded to that earlier, but so financials is a huge part. So like say if you can drop in 36 months worth of management accounts, probably an export from your accounting software for that 36 months, just in case you want to manipulate the data and play around with it. You're going to be dropping in, like say, things like, from a finance perspective, your year-end accounts, any share work that's gone on. So that will go in the finance section, but then you'd also be wanting to build out a HR section, a legal section, an operations section. And again, these are all things that why not start it now? Like business owners, why not start having like it's obviously good practice. Like, I know it sounds obvious, you should be saving down your contracts, but have you got them in a really clear and obvious and accessible place? Contracts are slightly more obvious, but what about your lease agreements? If I said to you now, can you go and get me a lease agreement for the last 3 years? Can you get them? So it's almost just like, and again, we do have example original DD questions. So like I said, the original questions, is probably 100 or so of them, but they evolve into, every one of them creates 5 or 10 more questions. So if anyone just says to us like, oh, can we just have a look at that, we'll happily share them with you. Because like I say, by looking at those, it gives you that, okay, that those are the kind of things that when I come to sell my business, people are going to be wanting. So why didn't I, in the spirit of sort of transaction readiness, stop pulling them together now, essentially?
I think that leads into the next slide. So vendor due diligence, that's what it is really. Vendor due diligence is vendor as seller, so shareholder, doing their own internal due diligence before, because when you go through a process, a buyer will want to do due diligence. Vendor due diligence is doing it yourself beforehand. So speaking to advisors, speaking to people that have been through the process, where we can provide, like you say, lists to go through and start to work through it and say, okay, we need to get X, Y, and Z in order. So that's what vendor due diligence is in simple terms. It's, a seller initiated review of your sort of operations, financials, legals, looking at risks, because there'll be tons of things that you won't even think about, environmental stuff. So there'll be lots of questions around IT, environmental, and these are the things that you won't be thinking about, and rightly so, because you're trying to run a business. But if you've got all these things ticked off before, it just means you don't have to worry when it gets to that point. You've got it in a place, it's ready to go. It's often and what's really important during and why it's important to do vendor due diligence is that, again, it goes back to that transaction, that execution risk. If all your ducks in order as well, what's really, really important is when you go through a process, Sam's touched on it already, it was super stressful. Well, if all your ducks are aligned, you can just focus on running the business. And that's really important as well, because when you come for sale and you're going through a process, if you have to spend hours and hours going through collecting this data that should be there already, really, in reality, if you're well prepared, well, how does that affect the business performance? Are you key to that business during that time? Because the last thing you want to do is for trading performance to start to drop as you're going through a transaction, because a buyer wants to be confident that they're buying the business, and really, if you're a seller, you're not key to that business. But if the performance starts to drop, again, they start to ask questions. So the more prepared you are, the more likely you are you'll be ready to sort of focus on operational matters, running the business, as opposed to getting all this information ready. You've done it; it should be done and ready to go. So again, a vendor due diligence process is really, really beneficial for a lot of businesses. And once you do it once as well, okay, there might be certain things that a buyer might want to see that we've not thought of, but that should be 10% of the questions that are likely to come. You've done the other 90%. So really, really beneficial thing to do, because it does make you look at your business in a different way as well and think, oh, right, okay, we need to think about this.
Yeah, thanks for that, Lee. Like I say, I think that's why it's useful just having someone who's like I say, for me, I went through the process in a big way from start to finish. But for Martin, obviously, he sees these transactions. He'll done hundreds of transactions throughout his career, kind of thing. So it's just almost having that thought process essentially.
And I think like vendor due, we're there to handhold, during the process. But what we can't do is give a lot of the data. We can give a lot of the financial data if we look after management accounts, etc., or work with your accountant that does the management accounts. What we can't do is go into operational matters. So when we're in a process, yes, we can help and we control things, and again, make sure you're spending time on other things. But where we can't answer a question, we're still coming to you beforehand. So if you do the vendor due diligence before, again, it's less work that you're going to have to do when at the key point when you're trying to sell your business. So yeah,
a couple of bits to add to that from like Jay, just from experience going through that. I think with the document side of things, I literally every document that we uploaded onto that portal, I looked through, and some of the things that we probably uploaded throughout the process probably I changed how we positioned them more than anything, because the way we positioned it could have caused issues. At times we were trying to give too much information away. Like they're asking a question and our team were pulling together information, and it felt like we were oversharing. And so it's all about giving the right information that they want. To save them time, it's not hiding anything, but also, like I say, answering the right questions, and that was really key. So it meant me looking through hundreds and hundreds of documents, but looking back, it was worth it to get the transaction over the line. The second point that I think was relevant there was about the operation side. So like I say, it was, so there was me. Like I say, there was me from the finance side, and we were very lucky to have a guy who had probably joined the business a year before, and he was basically coming in to do a sort of what his role even became by the end, but like almost project work. So his job was to manage projects. So now he's doing a lot of acquisitions for the business. Now they're backed by a private equity firm. So it was so important for me to have him there, because like I say, the directors, we were like, you guys just need to carry on running this business, carry on growing this business, because the last thing you want is a dip in the last month before they sign it, and then again it's questions, and are they going to chip you, and are they going to chip you way more than you should, and are you now at that point where you're at the end of your tether, like you've been through 6 months of this due diligence process, and they chip you by a couple of million, and you're just going to be like, you've got a decision to make. Yeah. You've been through war basically. Are you going to accept that this big company are going to sort of like showing the strength, or are you going to fight back, kind of thing? So it's just, you just don't need it. So like I say, by having me and him were the ones who were just battling, and then like I say, the director team at times probably didn't know really what was going on. They were asking us how's it going and stuff, but we were like, we're doing it. Like we're going to keep it moving forward. So I think that is really important. So, like I say, if you get into that point where you are considering selling, having someone who isn't necessarily you, unless you manage your way out of the business, and therefore the business runs itself, and you're going to be that person. But there is a massive input needed by someone who knows the business inside out, essentially.
Yeah. Okay, so crafting pitch deck then. So this is pitch deck or IM really. So what we're talking about here is, because I think it's a useful thing to again start doing beforehand, because often what happens if you're giving your business to sell it on the open market, for example, you've got to create a pitch deck or an information memorandum, it's called, and that details everything about your business. So basically, if you're going to sell your business, you've not really got a buyer lined up. Well, then we can go to the open market, but we've got to give enough information away there to attract the right sort of buyer. So that's what we mean by pitch deck. I do think it's one of those things. Again, it's part of, yes, it's done at the time of transaction when you want to sell, but thinking about it well in advance. Again, it's just about being over prepared, if you like. So an IM will have things about your customers, your suppliers. It'll often be anonymised, so to reduce the risk. But have you got an organisation chart? Do you know who your key staff are? What's your market that you operate in? What are the growth opportunities? What are the USPs about your business? So if you can start thinking about these things well in advance, when it comes time to sell, that document's going to be a lot easier to prepare, or it's already been prepared, ready to go, and you're just updating it. But it is a really, really sort of important document, because it's basically what we want to try and do by creating a pitch deck in IM, especially if you're going out to the open market, is to give the same information to multiple people, so that when offers come in, you're comparing apples with apples and not apples with pears. You're not telling one prospective buyer one thing and one another. So that, again, it's all about centralising that information. And I would suggest, yes, we can do that at the time you sell, but getting the groundworks in place means that we're already there. You're already thinking about the USPs of your business. You're already thinking of the weaknesses of your business and how we articulate that, how we turn that weakness into a selling point. So for an example would be, if you've got a customer base that's quite concentrated, and what I mean by that is you're quite reliant on one or two key customers. Well, what's the relationship with that customer? Have they been a customer for 30 plus years? Are you basically embedded with that customer? You need a document to basically show that, because if you just present a debtors or a turnover by customer list to a buyer and a financial without any narrative there, any explanation, or you don't see that that's quite concentrated and that's a risk. If you don't articulate the story, they're going to look at it and think, oh, that's too risky for us. What if that customer goes away? So you've got to, it's about that storytelling. You've got to give a buyer an understanding of, okay, yes, we understand we're concentrated, but we're embedded. For them to use somebody else will be a massive decision. So again, that can all be in the pitch deck, and getting that together is quite key as part of any sales process, really.
Yeah, I think, like I say, for anyone who uses account software, Xero is obviously one of the ones we talk about the most. There is a report you can run off Xero which will give you your top customer list essentially, and you can run it for a month, or it's very customizable as just like your like P&L reports and stuff, so you can change the date range you run it for. And again, that was one of the big questions that was asked of us. Like I say, who are the top customers over that 3-year period, and then again, that one question led to 50 more questions off the back of it to really understand that relationship. And like I say, length of contract, this is when like contracts lengths and all that comes into play.
Yeah.
Or like I say, obviously there's not always going to be contracts, but like I say, relationships and stuff like that are so important.
And I think another key thing about a pitch deck as well, which I sort of missed, is that, if you get this deck together early and get that storytelling piece together, if you do get interest along the way, maybe before your timed period, you're ready to go, you can send a prospective buyer this document, subject to them signing a non-disclosure agreement, keeping it confidential. But what it does as well is it avoids time wasters, because when you come to sell your business, you'll get a lot of people that are interested, but really we want serious buyers. We want people that are interested in your business. You don't want multiple meetings with these individuals if they've really not, have no intention of buying the business, or not going to get favourable terms or deal structure. So if you've got a deck ready, you can show it to them, and then it's a case of, okay, if they're interested, then let's have a meeting. So you can almost use the document to streamline that process as well.
Anyone on that one?
Yeah, good. Okay, I'll touch on this one. So what are the methods of selling your business then? So, because this is often a question that's asked. There are 3 main ways of selling your business. The other exit strategies are, there are 3 main ways of doing it. And then you've got I would say, another option that's not favourable, and you should never sort of really go down unless it's a last resort. So what are those options? Trade sale. So what we mean by that is selling your business on the open market, typically to another business. That can be often somebody, it could be private equity, so a business, an institutional investor that comes in, sees the growth potential of your business, wants to invest, and they'll look to scale it up. It could be a trade buyer, so someone in your sector, so maybe you've got a unique product and you've got maybe a customer or a supplier or someone in a close complementary sector that likes to grow through acquisition, and they might look at your business and want to buy it. The reason why is often there might be sort of synergy savings there. So they might look at your business and think, oh, we can save costs. But 9 times out of 10, when it's a trade sale, it's more about growth opportunities. If they buy your business, that'll open up a market. So maybe they sell it to a certain type of product, but they don't really go into your market. Well, if they buy your business, it opens up other doors to improve sales. So there's lots of different reasons why a trade buy might like your business, and that's one method. That's often, we put it as the first one because in terms of valuation and deal structure, it tends to be the best. So if you've got a trade buyer involved, often they're ideally bigger companies that have got the cash. So again, from a deal structure point of view, they should be able to provide more day one cash to you, more favourable, de-risks for you as a seller. And 2, they should be able to do it quicker as well in terms of the transaction, less complications involved. The downside often is that if they are close to your business, if they are a customer or supplier or someone really, obviously they get to see your business. That's part of the process. Is you've got to show them details about your business, and that might involve sort of commercially sensitive aspects. So again, as part of the process, we've got to be really careful about what information we're willing to give at certain points. So I've touched on it earlier. In the pitch pack, for example, you might give your a detail of sales by customer, but we don't want to tell them who the customers is. We leave that till the very last minute, so they can see concentration levels, they can make a judgment, but we keep that as we want to get really confident that we want to make sure they've engaged solicitors, they've incurred costs to do with the deal, to give us confidence that they're not just going to come in because they want to see your customer ledger, if that makes sense.
It seems an expensive way of spying on people. Have you seen it in practice?
I think bigger companies tend to do it because they've got the budget to do it. So talking huge companies. So it's always, you've got to look at the buyer and think, well, again, do they want to? But when you go through a process, if you get a buyer that hasn't engaged with a solicitor yet, they're wanting to see certain types of data without incurring costs. Well, that would make me nervous because I'm like, well, what are they just on a fishing exercise here? So again, this is where having an advisor on board will be able to give you these an opinion on it, whether we feel comfortable doing it, and also what data we should be giving at the right time as well.
I found by going through the process again, the company I work. We were also acquiring, and it was always way more beneficial when it was advisor to advisor.
Yeah.
Because you almost like I say the health group, they were acquiring smaller private practices, private physiotherapy practices kind of thing. And again, some of them we were just dealing with the owner of the business, and you end up having to do double the work trying to explain it on their side as well. So like I say, no matter like I say, the transaction you go through, I think, like I say, advisor to advisor is key.
It is, yeah. It just makes the transaction smoother, and it allows the business owner to be the nuclear option button as well. If negotiations are sort of stalling, well, that's when the business owner needs to come in. But in between, it needs to be the advisors having that conversation and acting on your best behalf. Lee, I've seen a question. We'll come to that in a minute. Just after this slide, we'll have a look at it. Just talking through the other 2 main exit options that you might have heard of. So management buyout or management buy-in. So that is essentially selling to your team within the business or an external individual that's maybe backed by a high net worth, or maybe they've got some funds that they want to or at their disposal to buy into the process. So we put it second on the list. The reason why it's second on the list from a seller's point of view, it often valuation, you can probably get similar valuation to a trade sale, but deal structure's less favourable. So, and the reason for that is because often management buyout, you're limited to maybe your team beneath you can put in a bit of cash, maybe one-time salary, but it's going to be hard for them to raise X millions. They might be able to go to leverage the business, the company that you're running to raise some finance, but it's not going to be anywhere near the amount that a trade sale would go through. So we put it second on the list. It's definitely a good exit option, particularly if your management team have shown appetite, they want to take on the business going forward. So yeah, it's on there. It's a way of selling your business. I think it's often, I think with a trade sale, if you've got key management in there, I'd always look at it as an option, especially if you you're concerned with legacy, etc. You want the business to continue. You might have had that individual in for a long time. It's another option.
Yeah, I think during the process I went through, there was actually an MBO the year before, and that was because the shareholder split wasn't probably right at the time, and so you had one person who was probably responsible for over 80% of the revenue, his business unit, but he was a smaller shareholder, and so at that time the shareholding, whether it was an MBO or an MBI, technically, I suppose it's up for grabs, but essentially some of the other shareholders diluted, some exited because they were no longer part of the business, allowing shares to be freed up to redistributed in a fairer manner. But that was pretty integral, because the person who ended up being the receiving the additional shares, he was so integral to that business, and so it allowed him to drive that second exit. If he continued to be a more minority shareholder, he would have been less driven to get the deal that was got. So again, making sure that distribution right is key, and that's, like I say, how we went through both arms of this. And again, MBOs are hard because, MBIs, depending which way you go, management buy-ins are hard because it's people arguing what their worth is to that business, and so it definitely puts strain on relationships, but at the end of the day, they came to an agreement that worked for all parties. So sometimes having those tough calls can be tricky, but can be worthwhile. And then the ultimate was a trade sale, and like I say, it's listed there as 2 words, but there's thousands of ways it can go. Like the things you need to be thinking about are, what do you want to do on exit? Like what? So these are the conversations we were having with all the shareholders. So the day this business sells, what do you want to do? And there was a good split. There was one person who was wanted to leave. He'd done his work. That was him retiring. There was a couple of people who were outsourced who again wanted to manage the handover and move on. And then there was a non-exec director / someone who sort of sat on the board but wasn't involved in the day-to-day, and obviously, like I say, he just wanted as much money as soon as possible. And again, so you decide what you guys want to do after the transaction, but then the other part to it is what are they going to give you? How much are they giving you up front, and how does that get distributed? And in this transaction, like I say, we were very lucky to sell to a private equity firm who had significant cash, so they paid everyone out on cash on day one, except for one person who they said, look, it's integral for you retaining this business, and therefore we're going to have to pay you over a couple of years to keep you driven. And like I say, he had other incentives and stuff like that, but like I say, for them, like I said, there's plenty of ways a trade sale goes, and it's sort of, again, but going through that process at the start of understanding, you do need to know what you want to do and where you want to go, I'd say.
And I think that's a really good point about, like, a buyer coming in. They are going to identify who the key people are in the business. So if you're a seller and you're still key to running that business and you haven't got a strong management team, well, they're going to tie you in some way in terms of a deal structure. So the more you step away, the more you encourage your management team to step up and for them to run the business. It lends itself well to a potential management buyout or buy-in and a trade sale. You're just going to get favourable terms in that scenario. So it's all about, trying to step away as a seller. It's really hard to do, and then it's about timing as well. So again, we can sort of advise you along that journey. The last option, so methods of selling, they've been around for a while. 2014 employee ownership trust. So again, it's an alternative way of selling your business. What that means is you're selling your business to a trust. The beneficiaries of that trust are the employees of the business. So it's a bit misleading because the employees don't own the shares of the business. So when it says ownership, it's not the employees that own a business, it's a trust that sits there. The employees are the main beneficiaries of that trust. There's lots of tax incentives for doing that. So at the minute, there's a 0% tax relief. So if you sell your business to a trust, you don't pay any tax. I would say, though, if you're going to go down the employee ownership trust route and you want to sell your business to that way, you've got to okay, yes, there are tax incentives there for doing so, but you've got to do it for the right reasons, otherwise it's not going to work. And the reason for that is that if you're still integral to the business, often how employee ownership trusts are structured is that we do a valuation, agree it, but often there isn't, most of the valuation is paid up over time. So if you're still in the business and key to it, you're going to be working to get that value that you've generated on day one. And also, just in terms of that buy-in, you've got to have the sort of team that, I would say employee ownership trusts are suited to businesses where you haven't got necessarily that key team underneath or that key person that wants share ownership, that haven't got that sort of drive to own shares. Employee ownerships can work well there because it's like a gradual transition. Post-transaction, you sort of help those individuals. You can step away and say, look, I've sold my business now. I'm here to help you over time to get to that point. So I would say be very careful of employee ownership trusts. Yes, there's huge tax incentives for doing it, but you've got to do it for the right reason. That's what I'd say. So they're the three main options. The other exit option, which is a worst last case scenario, is obviously insolvency. So when you get to the end of your journey, you could just wind the business up and sell it. You've got no obvious trade buyer, you've got no strong management team in place, and therefore the only other option is to wind it down. I would say that is last resort because often most businesses have got a lot of value in them, and I would say that is the worst case scenario that you want to go down. I've suggested it's not a strategy. I would say it's more of a last resort option, but you can go down that route as well.
Last slide.
Yeah, it is. Yeah,
We've timed it well as well.
Yeah, I think so. So basically, it's just this last slide, experts guidance. I think Sam stressed it before. Hopefully, we've articulated, especially with Sam's example where he's been embedded in a company. I obviously see it from an advisory point of view and have worked and helped with lots of clients. Sam's been there. It's stressful, and that hand-holding process is really important from a tactical point of view when it comes to negotiation, but also taking the stress of burden off a transaction, off the business owner, so you can concentrate on running the business. I think that's the main thing, that you want advisors on board that know solicitors, that know how transactions work, that can identify. The worst case scenario from my point of view is if you're handing a buyer a piece of information that could compromise the valuation or the deal structure, or you've not articulated it in a way where they're going to look at it and think positively about it. And that's the benefit of having a buyer on board and controlling the process. Whenever information is sent to us, we'll look at it and think, oh, I'm not sure I want to articulate or send it over in that way because the perception might be X, Y, and Z. Like, can we rephrase that? So it's just having someone there to bounce ideas off and make sure that I'm looking at it from a buy side point of view. Well, what would I expect? What would my reaction be if I saw that piece of information? So that's it really.
Perfect. I think like I say, I think obviously James has raised a point about an example where people have gone through this massive rebrand and it has backfired. So I think what part of the reason why we do these webinars is to create these kind of conversations. And like I say, we've got 6 people, which is great. I'd love to probably get a few more in. So like I said, we'll catch up with you guys afterwards. But thank you so much for contributing to it, because like I say, it's key. And if you've got any ideas how we can find ways to reach more people, that's all we want to do. Like I say, I've gone through that process with that business, which has basically created me time now, because I went from running a portfolio to basically running that business to then doing a lot of sales and marketing at Gravitate, and now I'm in a position where I just want to sort of give more back to you as our clients, and create spaces where people can have these conversations, because like I say, obviously I can see that Lee's taking stuff from James and vice versa, so to be able to create a space where you guys are interacting and giving each other value is equally great for us, really.
Yeah, no, it's really good point, Sam, because often, again, I go back to that point, there's no silly question, and we need to encourage that, because it often drives other conversations and you're getting our advice as you go along. So it's great that there's quite a bit of chat in there, and if there's other topics or areas that you want us to discuss, just let us know from our point of view, and we can look at putting something together. It's more about creating that room where people can openly talk and try and help each other. That's what we want.
Yeah.